In this video, guys, we're going to look at tips to avoid overtrading in volatile markets. Stay tuned. Hey guys, welcome to you. So as I'm filming this, the markets are going crazy. We have lots of movement going on. Our coronavirus is affecting things hugely. I've got some ideas for you that perhaps you might take one or two of these away and help your own trading. That's the whole point of all the videos that I do for you guys on this channel. If you can take one or two bits away that just improve your trading a little bit, not only does that accelerate your learning curve, but hopefully you make more money off the back of it as well. No promises, of course, but hopefully it does. Okay, so let's have a look, guys. Number one, frame the market. What do I mean by this? So listen, overtrading, super common thing in volatile markets because there's so many things going on. You've got so many markets moving, you've got your favorite markets moving, they're up, down, up. There's so much opportunity that you think, I should be trading, I should be in and out and the other. And listen, guys, I fall into this trap very often, but I'm quick to kind of go, well, easy. You got a little bit too aggressive, trading a little bit too much, you're going to start to notice some problems. And I think that's the key. Is like, as I've always said, guys, experienced traders, we don't have the answers to everything. We just know a little bit more that, hey, we've done this before and it doesn't serve you. And so overtrading is something that we can slip into because there's so much opportunity. You find yourself, this setup, that setup, and you're gonna have to be very brutal about it and say, listen, I want to wait for this specific setup or these setups in this markets, and that is it. And there's a mental thing, and we'll get to that in number three, is there's a mental aspect to having a plan and a strategy, even if the market doesn't actually trigger your setup, just saying, you know what, I was doing something, I was engaged with it. It doesn't necessarily mean you have to be in a trade. You just didn't get your fill, you didn't get a setup you wanted. And that is the most professional approach you can take, rather than punting long here. Sure, it's down too much, I'm going long, it's up too much. That is the way that you'll just end up wiping out. So the first thing, guys, is to frame the market. What am I frame the market? So if you can imagine, we'll just draw a little quick thing here, if you can see it with the lights. You can imagine that we have, in fact, I'll put it here. Imagine we have the market kind of swinging around wildly here. The easiest thing to do is just to say, you know what, this, under normal conditions would be so much opportunity. That might be an 800-point range on the Dow. But if you just frame it, you put your high and your low in, or wherever it may be, and go, you know what, I'm only going to get involved if the market comes out of that range. Then I'm going to look at it. And so what it means is you're not looking at every swing back and forth. You're not here going, wow, it's up 100 points, down 500 points. And you're going, crazy, because your normal reference point is that's a big move. But in these conditions, it's a normal move. So reframe your reference. Assume that, hey, I only want to get involved when I start to see this. And that helps you, especially if you're monitoring multiple markets, you swing traders out there who are looking at kind of some stocks and this and that and the other. It just helps keep things categorized. Like, hey, that stock is still in that range, I'm not interested. Oh, interestingly, this stock's now broken out of that range. Great, I might look at that because I'm thinking of a momentum ignition play on that, or whatever the case may be. You get the idea. Framing the market, very good for keeping you a little bit less cognitive load going on, a little bit less noise. All right, number two, consider only checking certain times. This has worked very well for me in the recent volatility, actually. And that is restricting, because I fell into the trap, I say it's falling into the trap, guys, but you start to recognize that this volatility is going to carry on. The first couple of days, great, you're flat out, the opportunity is great and you're there. Then it starts to become, there's so much going on. It's like, if I'm sitting in front of this screen and I'm watching this heavy, even with positions on all the time that I know I've got to stop here, I've got a limit there, this probably isn't the best thing. So one thing to do is, and it's worked very well for me, is checking at certain times. So when I've got my positions on, or perhaps I'm waiting for a certain level to get involved in it, or whatever it may be, then you can say, hey, you know what, apart from obviously if you've got a level alert, but let's check it at separate times. I'll check at the European Open, so let's see what happens at 7:30 till 8:30, check it then. Okay, let's see what happens at about lunchtime, let's see what happens before the US market, let's see what happens at the Open, let's see what happens at the European close, and let's see what happens. You get the point. Now, when you check it, it's entirely up to you, and obviously revolves around your other commitments as well, but even if you don't have other commitments and you are into trading fully, it's still not a bad thing to say, okay, I've got my position on, I've got my risk parameters in, I know what my limit is, but I'm not going to start dabbling with it and taking profits off the table until either this time and then I'll review it. So let's say you kind of gone short, the market's gone hammered, bounced back up. You don't know, you're not getting involved in all that emotional swing until you're logging in and saying, okay, what's it done? Right, it's done this, done that. Do I need to move my stop? No. Do I want to take some off the table? Maybe I'll do if we get a little bit more stretch. I'll put a little limit in for a tenth of the position, or whatever the case may be. But that way, you're not constantly trying to moderate the thoughts that's going on in your head of like, oh, this is going up, it's going, because the swings are so big. So just try to kind of dampen down the flow a bit, and actually you'll probably find that your actual bottom line will improve massively, because you won't be so keen on over trading, you won't be meddling with your positions. Now sure, you're going to miss opportunities. There's times when I've I've taken a position and the market's been massively in my favor and it's reversed on me, and I've come back and I haven't been able to take an opportunity to take advantage of that, and I've gone, okay, it is what it is. But more times than not, it's probably helped me out that I've not been meddling with it, adding to it when I probably shouldn't have, trying to get too aggressive, which is my big thing, trying to push too much when it's, and then it allows you to be a little bit more calmer. And also, guys, the thing of even when you're out and about, guilty as well, going out, hitting the gym, you're on your phone, what's the market doing? What's the market doing? That is just no use, because you're constantly, and your mind's constantly on the market, and you don't get a chance to refresh. If you're hitting the gym, you're running, you're doing all these kind of things that are helping you out, you need to be fully committed into that, not sitting on the bench after you've done a bench press, just seeing what the Dow's been doing. I know it's tempting to fall into, and I've fallen into that trap before, but it's not worth it, guys. Leave it in the, you have music on, don't you? So have it in your pocket, but don't look at the charts. All right, guys. What have we got? Number 3, leave in limit orders. And this is a nice little hack actually, because what it means is when you leave a limit order in, you're saying to your mind, that's what a level I want to get in at. So you have ticked a big box in your mind that says, I am involved with the market. And this is where it gets quite clever, because when you don't have a limit order in, your mind is saying, I'm a trader, I should be involved in this, I should be involved. And so you start to look for a trade, a market order trade, long, short. Whereas if you have a limit order in, the big tick in your mind says, okay, I am already involved, I'm waiting for this price to come to this level. Now that could be quite an extreme limit. That could also be a stop entry. I've had a few of those stop entries. So you want to only get in when it goes through a certain level, shorting through a low or buying through a high, whatever it may be. I'm not going to talk about strategy so much in this video specifically, but that then ticks the box that when you're not actually in a trade, or you're thinking, oh, the market's moving without me, I'm going to miss it. You say, no, I actually have a limit order. And if it doesn't get filled, it doesn't matter. You don't feel as if, hey, I should have done something. You did something, you just didn't get a filled on it. You were very specific about the price you wanted. You didn't get it. And that really is a kind of good little hack, that one. It's one of my favorite ones, guys. Number 4, restrict the number of markets you watch. Pretty common sense. It's tempting to watch everything, and it is super interesting, and maybe I don't really follow my own advice on this, because I do like to watch all the stuff that's going on. I'm super interested in what some of the stocks that I'm watching are doing. I'm interested in what European markets are doing. I'm interested in what gold is doing. I'm just interested in it. But I know that I'm only going to trade a few things, but I know what I like to trade. So I'm not going to get distracted and start trading bonds, for example, because I don't trade bonds. I'm not going to get distracted and start trading or whatever else it may be. You get the point. So even though I'm doing what I say here, if you can watch them and still only trade a few, fine. If you can be strict and go, hey, am I going to watch 2 markets or 3 markets, then that's good as well. But the point is, guys, is just, don't try to trade everything. Don't try to watch everything very quickly. I think it's okay maybe to, in the evening or whatever, to see what did oil do. Oh, that's really interesting. Or what did gold do? That's interesting. But if you're constantly getting, daily updates or hourly updates about all the markets, it's just too much. You can't make a solid decision on it. Unless, of course, you've got a strategy where you're looking at multiple markets as one, and you're saying, right, well, that's how their money's flowing around. I'm making a decision on that. Of course, that's a different operational consideration. Number 5, guys, turn off the news. It's a fine line, this, and I don't know what the real answer is. I've got something that works for me, which I'll share with you now. But hey, we want to be informed, because this is a news flow based market, right? We are super interested in what and also when you're watching the markets, you tend to see what's moving the markets. So new cases of new countries, that's died down a bit. And in the initial phases of this virus, Every time we had a new country, new cases, market would jump or dive more likely. But now that's dying out. Now the news flow is more based on, hey, what are the White House saying? What's Fed saying? What are we expecting in terms of some sort of stimulation for the market? All this kind of stuff is more what's fueling things. We kind of know where we are a little bit more. This is still unknowns, of course, and so you can get into the trap of looking at every single piece of news. Oh, this country did this with that did that. And then you kind of miss the bigger picture. So again, as with a lot of these things, guys, it's filtering out the big blocks that are useful. And at this very moment, which could change tomorrow, the big blocks that are useful are what's coming out from the White House. They have the press conferences and they're saying things that are saying, hey, we're doing this, we're doing that, we're going to do this. And that's the kind of things that is driving the markets more. People are looking to see how central banks are going to respond. That could change depending on how news flow changes and what traders are looking at. Like I say, maybe a week before, it was all about the virus. How's it spreading? Where's it spreading? Who's got it? And all this stuff. That was what was really fueling things. Now it's transitioned. Maybe it'll transition again to something else. So if you're focusing on the thing that you believe is what traders are watching the most, at least then you're not going to get bogged down with it. And the other thing about watching news all the time, guys, is, and by the way, what I do is I use Twitter, and on Twitter I will have very useful feeds. I won't have all the noise because it's very easy to get clouded with noise with so many people's opinions. But if you have kind of one or two feeds in a list and you just follow that, or set up a separate account and just follow a few useful things, like really dialing down onto people who are providing facts and factual information out, then that becomes more interesting. It's like, okay, well, that's what I'm following. Otherwise, you end up looking at opinion based on, and listen, at the moment in time, guys, we've got two opinions which both have valid argument. One is that, hey, this virus is going to really wipe out massive parts of the economy and we're going to struggle massively with it. The other part of it is, hey, we're going to bounce back very, very quickly. And there's valid arguments for both, and both are really vocal, but both don't know. Now, as a trader, I'm not trying to be opinionated one way or the other on it. Of course, we're humans, we're going to have biases and little opinions inside us, but that shouldn't really influence our trade. We should still be saying, okay, is that a good trade setup? Can I manage the risk and all that kind of stuff? So if we can reduce that noise and just focus in, we will find ourselves hopefully in better trades and less frequently trying to overtrade as well. All right, guys, so those are 5 tips to avoid overtrading in these volatile markets. Please keep your risk managed. Bye-bye.